Morning, everyone. Thank you so much for joining us today. We have some people in the room with us and some participants that are online. We're really happy to be welcoming Inès Holzbaur, who is the Managing Partner of AmorChem, here with us today. And Inès will discuss the fundamentals and the inner workings of venture capital. So it's going to be a really great presentation. And just for our D2R community, Inès is also, we're very lucky to have Inès as a member of our investment and commercialization committee at D2R. And so she's been contributing to a lot of our discussions on commercialization, innovation, entrepreneurship, and investment. And so we're really looking forward to her insights today and to sharing those insights with our community. Welcome, Inès.
Thank you. Thank you very much for that kind introduction. Online is okay? The volume's okay?
Yes.
Super. All right. Well, thank you everyone online. Thank you everyone in person. I'll try to turn around once in a while and confuse the owl as much as I can. It's really a pleasure being here. It's a topic that I'm very passionate about. I've been working in venture capital since the late 90s, and more specifically in university project commercialization since 2011. In fact, and it's a topic I really enjoy, and I hope that you'll get something out of it. You can interrupt me to ask questions, be a bit brutal about it because I get going and then, you have to stop me. So people online, if you have a question, chime in loudly so that to remind me to interrupt myself and to answer the questions. So the goal today is just to give you a briefish introduction into venture capital and into how you fund a startup when you start one, whether or not you're thinking about starting a spin-off company, just the idea of how this all works. And I think it's particularly important to understand how venture capital works from the inside, because if ever you do start talking to people in VC, you have to understand their issues, their challenges in order to have a very productive conversation. I think it's important that both sides know what each other's issues and prerogatives are. So let's dive right in. I'm going to cover 3 topics. I'm going to talk about the sources of capital for biotech startups in a more general sense before I zoom in on VC. We're going to discuss the structure of a VC fund and its priorities. And we're going to talk also about the relationship between a startup and a VC once funding has been gotten. So for startups, there are obviously many different sources of financing available. There are commercialization grants, especially the Quebec government has been quite generous in grants available for people who want to commercialize their research. There are foundations that you can reach out to that can make also a granting system for projects or companies that they want to support. You have your sales revenue. If you do have sales, you can reinvest your own profits into the development of your company. Angel investors are basically friends, families, and rich uncles. Basically, anybody in your network that has a lot of confidence in you and that has money to provide. And you have the 2 mainstays of biotech financing, which are pharma collaborations, or let's call them large strategic collaborations. Because whenever I speak about drug development. I speak of it from a drug development perspective. I understand that some of you might have medical devices or diagnostic tools. So I talk about pharma, I mean all of the healthcare strategic partners. So when you enter into a collaboration with them, you can get revenue out of it, which you can reinject into your company, and of course, venture capital. Whoop, I can't move. Here we are. Okay, so one thing I wanted to do is they're not all equal. All these sources of financing are not all created equally, and I wanted to rank them in terms of access. How easy is it to access them? So at the bottom of the pyramid, you have sales revenue and commercialization grants. Sales revenue is very limited in terms of access because if you're not generating revenue, then you don't have revenue to reinvest. I think we're all brilliant in this room, so that's a pretty simple paradigm. Commercialization grants are great. They're not that hard to access, except that they usually request or require even a private funding source. So you have to match the funds. So it's a little bit of a chicken and egg, because you might get a commercialization grant, but as long as you don't have other sources of financing, you won't be able to access the money. Axelis offers some, CPDM offers some, so there are different programs, and I encourage you to look at them. The smaller amounts, which would qualify generally as a private source to match a commercialization grant, and that have easier access, are foundations. So but it's project specific, right? Like you have to find a foundation that matches what you're trying to do. Angels, that's more serendipitous, right? Like if you don't have a rich uncle, you're crap out of luck. But you might also talk to different, you might fall into a conversation with a family office or for other individuals. I encourage you, when you're starting up a business, to talk about it as much as possible to as many people as possible, because you never know who might be interested. And then the toughest access, but the largest amounts of money, of capital, are VC and pharma collaboration revenue. So the first we refer to, it's a financing activity, and the second is a business development activity. So when you look at VC, if we focus on VC and pharma, it's really a similar process. There's similar requirements. Both groups kind of look for the same thing. They might not have the same end objective. VCs want to generate a return, and pharma want to develop a drug. And the two are not completely at odds, but they're not exactly the same. And they in terms of you looking for funding, they have pretty much the same hurdles. You'll face the same hurdles. So if we look at the positives of both groups, well, in VC, like I just said, you raise very large amounts at once, and those amounts or those sums can go into the entire company's activities. So you're not funding a project by project, you're funding a company. So you can fund your pipeline, you fund your management, you fund all of the different costs. VCs provide a network. When I started my career, I had no idea what VC was, and I went to an interview and I asked a friend who was living in California, and I said, tell me about VC really quick so I don't look like a complete idiot. And he said, well, VC, the biggest asset they have is their contact list, who they know. So when you have a VC investing in your company, you instantly have access to lots of people, which is very important in the development of a startup. And the decisions in VC, I don't want to say they're quick, because all of you are going to call me up in 6 months and say, what do you mean quick? So let's call it quickish, or certainly quick compared to pharma. Pharma, though, you have access to very specific expertise and lots of resources. If a pharma starts working with you, you have access to the entirety of their own organization, which is very important and can be very useful. And you also have access to a potential exit, because although you start with a collaboration, maybe at some point they'll want to acquire the whole kit and caboodle. In terms of negatives, well, VC is expensive money. I'll get into that, what I mean. $1 is worth $1, obviously, but it comes with relinquishing some control of, I say some, I mean a lot, of control of your company. And this means that it affects the future of your business. Where you want to go might not be where you end up going, because the VC money will come with its own requirements and demands. So you really have to be mindful of that. And it's a time-consuming process, although it's quick-ish, but in that period, it's going to be a lot of work. You have to pitch a lot, and a lot of it is going to be negative. It's a little bit like a PhD thesis. I think you're all prepared for that world where you do so much work and your thesis comparatively pretty short compared to all the man hours you put, or woman hours you put in. In pharma, the negatives are outside influences. What I mean by that is that pharma, a little bit like sheep, not quite, but they follow trends. So if you're out of trend, you're out of luck. And it's going to be very difficult to find a pharma who's bucking that trend, right? So right now, everybody's looking for obesity drugs. Whatever you have, if you're working in obesity right now, you're the golden child. You're not going to be the golden child very long, but you've had 2 really good years there. 5 years ago, it was a desert. There was nobody to talk to. So, the flip switch, the flip switch is pretty fast in terms of what they're looking for. It's a very slow process, because when you talk to pharma, you have to understand that you're generally talking to both the business development group, so the people who are actually going to negotiate a deal and who have a shopping list of things that their employer is looking for, And you're also hopefully talking to someone on the scientific side who really want as a champion, because the moment you have a champion, the business development goes faster, because the business development is driven by the scientific people. But that means you've got to talk to two groups all the time, and you have to have several conversations. And it's also difficult sometimes to figure out, are they just talking to me and asking questions because they want competitive intelligence? Or do they actually, are we getting anywhere? And so you have to read between the lines of that conversation. And it's susceptible to strategic shifts. What I mean there is in AmorChem 1, we had a project that we funded with Université de Montréal. It was in a rare disease, and this was at the moment where pharma really liked rare diseases. So we had a very nice deal with Roche. There was a 2-year collaboration between the university, medicinal chemistry service provider, Roche, and we were managing the whole thing. And we had meetings every 2 months. The whole team, 14 people from Roche would descend on Montreal, and we'd meet and review all the data and the progress and everything. And at the beginning, everybody was so excited about this project. And then all of a sudden, Jane left and Susan came in. And then Pete left and Mark came in. And the people around the table from the Roche point of view were slowly changing. And slowly but surely, their conversation was changing as to what would make it a success. Why would they internalize this project at the end of the 2 years? Whatever we said at the beginning, whatever we negotiated, that started changing because the people we were interacting with were changing. And this happens frequently in pharma. People don't stay there forever. So once you start talking to a different person, all of a sudden your project isn't a priority anymore. Or at the beginning, because it was a rare disease and we were testing in patients, immortalized patient cells, at the beginning we were told very clearly, you don't need mode of action. We don't really care. We want to see a phenotypic change. By the end of those 2 years, with everybody around the room having changed, MOA had become crucial. And the fact that we didn't have MOA tanked the deal in the end, and they walked away from it. So be mindful of that. It's a large corporation. You have no control over their discussions, and most of the time, the people you're speaking to and interacting with also have no control. So let's zoom in even more into venture capital. VC was really created in the beginning of the 1900s, and it's a special class of investment, which is part of the private equity umbrella, meaning investment in private companies that are not listed on stock exchanges. And it was created specifically to fund high tech. Now, what they meant with high tech in 1920 is obviously completely different than what they mean with high tech now, but the concept was to create an asset class where you can invest in innovation. Why is that different from doors and windows? Well, you don't have assets, right? Your asset is your intellectual property. If you start, let's call it a shoe business, you have inventory. So you go to the bank and you ask for a loan, and what's backing the loan, what's guaranteeing the loan is your shoe inventory. If you start up a biotech company or very much any innovative company, you have IP, which your loaner can't really do very much with. And you have a couple of computers, which also not much to do with. So that's why banking or the normal ways of funding companies don't actually work. It takes a very long time too. You need investors who are very patient and who don't mind that success might come in 7 years or 8 years. And you have asymmetry in information. Again, when you have your shoe business that you're starting, your financial statements are pretty unrelated to the actual business, right? Numbers are numbers and columns are columns. So when your banker looks at them, he or she understands how profitable your business is, what your projections are, and all of that. When you pitch a startup in an innovative field, and in biotech in particular, you're really pitching an idea, and you're pitching the promise of success, and you're talking about biology, you're talking about chemistry, you're talking about all sorts of concepts that the person loaning money in a bank does not understand. So they're relying entirely on you, or they would be relying entirely on you to make sense of what's going on. And they don't want to do that. They want to invest in or loan money to businesses that they understand. So the concept of a VC is we give money to a group of people who are themselves specialists, who are going to be able to understand the precepts of the business. And we're going to give them money for a long time, because if you're an institutional investor, so at the bottom, that list of pension funds, institutionals, insurance companies, banks, family offices, endowments, they're groups that have very large pots of money and that can allocate a very small sliver of it to extremely risky investments. They can be patient with their capital, but they expect in return very high profit on their investments, so very high returns. So how does the fund actually work? So the fund is structured so that you have limited partners. Those are our investors. They're called limited partners because they have limited responsibility with respect to our decisions. And they mandate a general partner, that's the team, that will manage the money and that will also invest in the fund. The partners in a GP have to invest a small amount of, well, relatively small amount of money in the fund. And then the GP is tasked with building an investment portfolio along the investment thesis that it proposed to the limited partners at the beginning. Why do you care about this? You care about it because you should remember when you're speaking to a VC, especially if there's a partner in the room, that you're talking to people who have their own money invested in it. So the decision is as personal for them as it is for you. This is your baby, well, this is my baby's money, right? So it's the same kind of the relationship that you have. The other thing is that many people think VC is such a glamorous job, and when I give these talks, I have a lot of conversations afterwards about, oh, how can I get into VC? It looks very glamorous, but actually we're very answerable to our limited partners, the same way that a company is answerable to its board of directors. So I have a lot of reporting to do, and I have to really make sure that my investment thesis is followed to a T. I cannot suddenly decide to do something completely different just because I think it's suddenly a good idea. And remember that an investment is not done in a vacuum. When I'm looking at one investment, I'm not looking at it only from the perspective of its own merit. I'm looking at it from the point of view of what kind of bouquet of investments do I want to have in my portfolio. If I want to do a generalist fund in life sciences, drug development, all diseases included, I'm going to make 10 investments, let's say, in my fund, and I already have 5 oncology. There's a chance that no matter how brilliant your idea is, if you're the 6th one walking into the room, that I might say, well, I'd really rather do some CNS right now, or I'd really rather do a bit of a rare disease one right now. So look, when you talk to VCs, look at their portfolio. They're all available online. I mean, we brag all the time. So look at what we've done and look at how you might fit into that portfolio. You don't necessarily have to convince us. That's our job, to convince ourselves about your spot in the portfolio. Like, you don't come in and say, well, I looked at your portfolio and I would fit, but you need to at least understand where they are. So the lives and times of a VC fund, also super important for your conversations, although you might not realize it. A fund is a fixed period of time. So I have access to this pool of money for 10 years plus 2 years of extension. In year 1, great, I close the fund, I have access to this money. In AmorChem 1, we had 40 million, in AmorChem 2, we had 45. We're ready, we have our investment thesis, we have a team, let's go. The first 4 years are going to be used to build the portfolio. So you have to understand that we said before, innovative companies, well, they take a long time to mature and a long time to reach exit, which means I only have 10 plus 2 years to generate a return. So I'm gonna have to invest as early as possible in order to give myself as much chance as possible for these things to reach success. So I'm going to build my portfolio in the first 4 years maximum. This doesn't mean I've expended all the money, that I've dispersed all my cash. It means that I've chosen the assets that I'm going to back. At year 4, generally I'll have at least 75% of the fund invested or committed, and then I'll start the roadshow for my next fund. Okay, that's going to be important in a minute. But starting year 4 with my existing fund, I'm going to be doing portfolio monitoring. I'm going to sit on the board. I'm going to make sure things are working, bringing help that the company might need, and I'm going to slowly start thinking about exiting these investments until year 12. So starting the roadshow at year 4, and then eventually, hopefully, closing a new fund at year 5 or 6 means that when you're talking to a VC, you want to talk to them in the first 4 years. Because if you go to a VC that's in year 8 and that has not closed a new fund yet, they don't really have money to invest. They're not going to be able to do new investments. It doesn't mean you shouldn't speak to them. You should speak to people all the time, but it means that you have to, again, look at the information. When was their latest fund closed? Does it make sense for them to make a new investment right now? Go to the industry cocktails. Talk to people and gather as much information as you can to see where everybody's at. And there's not a million of us, so it's not like you have to keep tab, like you don't need a massive spreadsheet. It's not like one of those detective things with the red strings on your wall. It's much more simple than that. And again, everything's available on our websites. But then it also means that I'm always managing 2 funds in parallel, at least 2 funds in parallel. And if I'm super lucky, I'm going to manage 3 funds in parallel, because the second fund in this slide would start at year 4, and then it's year 4. I'm still running the first fund, but I'm starting to raise the third one. Is that really clear? Super.
I have a quick question.
Yes.
For each round of funding, for each round of fundraising, would it always be the same LPs, or it could be different?
You have to have at least your existing LPs, because it's not a good look when people don't want to reinvest. But usually we try to broaden our list of LPs to invite more people in. So like I just said, this impacts your own fundraising. First of all, our new fundraising depends on generating returns in the past fund, right? So I'm going to have to make sure that whatever investments I make I'm going to, like, if I could show some results within those first 4 years, maybe with an investment I made in year 1, that would be super good. So I might be a little bit pushier at that time. If you're close to an exit, I might try to nudge you towards it so that I can raise the next fund. Returns are calculated in a mathematical equation that's based on time. So I need to regenerate returns as fast as possible in order for them to be as big as possible. But they're also based on time, just because things take long, right? So I expect that it's not going to be all done within 4 years. After the 4 years, I said before, you have to be talking to people all the time, because even if I'm fundraising for a new fund and I finished my investment cycle with the first fund, I'm building my pipeline for the next one already. Why? Because I'm going to have to deploy that fund really fast, right? So it is a good idea to speak to people when they're in the middle of fundraising and they're not quite ready for you to be inserted in their portfolio. Just take it with a huge grain of salt when they say, I really like your startup. I would like to invest in it. I'm dependent on my next fund closing, and a month. It'll be closed in a month, because that month will rapidly become 6 months, right? So just be aware that we are very enthusiastic and optimistic. It rarely pans out.
Inés,
Yeah.
would you say that sometimes you're speaking to people, a group, or you're looking at a project? What's the average time that you might look at a project? If you're not quite ready, does it happen that you might be looking at a project for 18 months before you're ready to invest?
Yeah.
2 years before you're ready to invest?
If someone comes to see me when my portfolio is closed to new investments and it takes me a year or 18 months, then that's a completely normal span of time to raise a new fund, then we might be speaking for 18 months before I can actually deploy any cash, for sure. So that's why you have to be talking to people all the time. So your timing, the bottom line is your timing is everything, and you have to make sure that you prepare all those planets that have to be aligned for a closing to happen. You also have to understand the investment thesis. Many people come to see AmorChem and apparently have never read the website, and they have a medical device company. We don't invest in medical devices. So I'll speak to you, because VC has terrible FOMO. Right, like the fear of missing out is really strong. So we will talk to everybody all the time. It doesn't matter. So getting a VC meeting is sometimes the easiest thing you can possibly do. But I still have to maintain my investment thesis. And so if I told my own LPs that I wouldn't do medical devices, I'm not going to do medical devices. If my entire thesis is based on late stage investments, so Series B, Series C, I'll talk to you as a startup. I'll even tell you that, oh yes, I focus on later stage. But it could be possible that I do a startup at some point. It's not my bread and butter, so the chances are it's not going to happen. So the stage of investment generally called, pre-seed and seed stage, then early stage is about Series A and Series B, and late stage is everything beyond that. Subsector preference is what I just talked about. It's someone who doesn't do digital health. It might be a really good project, but it's a question of the specialization of the team. We at AmorChem, for instance, we understand AI almost, but we don't want to invest in things we don't understand, right? That's why we specialize in certain subsectors. Some of us have geographic focus. AmorChem only invests in Quebec. So you can come from BC, I will take the meeting, but it's very unlikely, or I'm gonna ask you to move. Which is probably not something you wanna do, or I'm going to try to be creative and say, well, let's start the company in Quebec, would that be okay? You know, everything's on Zoom now, it doesn't matter, but be aware of that. Size of investments, there's a fallacy that everybody believes is that, well, I'm meeting, let's say, OrbiMed. OrbiMed's this huge New York fund. They've got, you know, hundreds of million under management. I only need $1 million. For sure, this is a great fund for me to speak to. No, it's not. It's actually the complete opposite of a good thing. Because imagine if you have $500 million to deploy in 4 years, or a part of that, or you're building a portfolio for 500 million. Investing $1 million at a time is going to kill you, because the amount of work it takes to invest $1 million is the same as investing 15 million. So I don't know if you guys have heard, but we're talking a lot these days about these huge seed and Series A financing. That's not necessarily driven by need. It's not that all of a sudden it started in about 2022, let's say, that in 2022, startup companies all of a sudden needed like 25 million to start, or 50 million even to start. It's that the funds got bigger. And so they wanted to commit larger checks all at once. So it's actually better for you if you're starting up to talk to funds that are a little bit smaller, because they are going to be more likely to write checks of the size that you will need. If you talk to a large fund and they decide to give you 25 million, be my guest, but just keep that in mind. And if you go to that kind of fund, don't ask for 500,000, right? That should not be the basis of your conversation. You should be much more ambitious than that. The other thing that's important, and that's not that easy to figure out, is the ability to lead investments. No financing round happens without a lead investor. You need the first person to say, yes, I'm interested, I'm gonna put a term sheet down. You need that person, then everybody coalesces around that, because you're going to need probably more than one fund in any given financing round. There are some groups who cannot lead investments. FSTQ is a group, is Centre Solidarité des Travailleurs du Québec. Their fund never leads. Investissement Québec never leads. So if you speak to them, they might be super interested, but they'll be sitting back until you find a lead, and it's your job to find a lead.
What's the incentive to lead the investment round?
You get to price, and you get absolutely a seat on the board, and you get to get it done, right? Like, the getting it done is important for us, because if we all sat back and never led anything, well, we'd never close investments, and we have to close investments. So the moment that you lead, you're running the show, and things go as fast as you want them to go. If you're not leading, then you're just waiting for things to happen, which is not a good place to be.
But that's the style for some investment funds.
So the funds I mentioned it's because they invest in VC funds as well. So the FTQ, for instance, is one of our LPs. So they don't want a pretty bad look of competing with us for lead position and for pricing. That's why they don't do it. But most small private funds will be able to lead.
Thank you.
So the relationship between yourselves and your VC. So congratulations, you've done 2 million pitches. You've spoken to people that have all told you that it'll happen in 3 months, and it'll happen 6 months later, or 18 months later, God forbid. And now at least the VC has said, we're going to move into due diligence. We are leading the investment. What happens? What makes you attractive? Strong technological advantage and edge. That's what you're selling. You're selling the dream of solving a problem. The issue with that is that you have to really identify the problem very well, and you have to be able to articulate it very well, and you have to really decide whether this medical need that you've defined actually exists or is just something you think would be good. The best way I can describe this is I once spoke to a researcher who was working in diabetes, and he said, I have this new target. If we develop a small molecule drug, it's going to be like, the next best thing in diabetes. This was a long time ago. It's going to be the next best thing in diabetes. And I said, okay. So he's like, first line, huge market, showed me slides with amazing numbers and all that. And then I started talking to clinicians who said, never first line, because metformin costs 2 cents to produce. We know it very well. So any new diabetic patient that comes to us is first going to go on metformin. Your thing might be amazing, but it's going to go much down the line of treatments. So that is an example of needing to understand what the actual need is. If you're doing an oncology drug and all you're doing is not, or what you're doing is not to increase the efficacy or increasing survival, but it's decreasing toxicity, that's a hard sell because people in oncology are unfortunately very used to toxicity. So the decrease in toxicity is going to have to come with a huge increase in efficacy. You're going to have to make sure that you're targeting the right patients, that you're going to be able to really define your patient population in the clinic. Nobody's asking you to know everything, obviously, but it means talk to clinicians. Like, especially in universities or research centers where there are medical schools or medical programs, I'm always amazed that there's not more conversation. This is not a criticism of McGill in particular at all, actually, but talk to clinicians. You have access to them. Figure out, how do they treat their patients? What do they actually need, the specialists? So what's your technology? Why is it better? Is it truly innovative? Or are you like the fifth in line? Like, don't develop a kinase inhibitor right now because the innovation has long passed, unless you have like a really nice way to develop new ones with new IP. It's going to be a tough sell. Does it feel a real medical need? Is there interest in your sector? Like I said before, we're also looking at how we're going to exit. So we need to know, is this an area that pharma is going to be interested in once you guys are ready to talk about exits? You need a convincing team, which doesn't mean you need everybody on your team right now. If you're doing, hit finding on a new target and you have a regulatory expert on your team, I'm going to think you're wasting your money because that person doesn't need to be on board right now. You're so far away from those considerations. But you need to know, who am I going to need later? Do I have a clinical path that's going to be a little bit difficult? Like, some clinical paths are pretty straightforward because you're like the billionth company to walk onto it. But especially in rare diseases, you can have a clinical path that's not quite that obvious. And so having those experts around you to talk about these things, even if you're still, struggling to optimize your molecule, is a good idea, because then when you talk to the VC, you have the full story of how the drug is going to be developed. Not all the answers, but at least you'll know who you're going to need on your team. You can have people on your SAB, or you can just have them as friendly people you can call once in a while. And you need a coherent plan. It's not up to me to tell you what to do. I am going to tell you what to do. But first I want to hear what your ideas are, and then I can contradict them, or I can confirm them, right? But I need something to start with. What are your targets? What's your next inflection point? What does success look like? I want to optimize my molecule. To what end? How are you going to know you're there? What's your target product profile? You have to have these things figured out. Is it going to take 6 months to get to the next step? Is it going to take 12 months to get to the next inflection point? How much money are you going to need? Are you going to generate some IP? And is there exit potential? Like, do you see in the market enough interest that eventually we're going to be able to sell your company to some other group or generate a pharma collaboration? So think about all these things when you start building business plans. And it's not that much use to tell me how large the market is. Okay, that's the first thing I know, is I know markets are large. Yes, there are many, many diabetic people. There are lots of people who are suffering from cancer. So starting with that big slide that shows the huge market that you're going to be addressing, we're going to spend at least a nanosecond on that slide before we move on. Unless, of course, it's a market that nobody knows. Then please explain to me how many people there are. Due diligence, however, is not foolproof. No matter how many questions I ask, I might make mistakes. And I'm telling you this, because I'm humble, and I think that VCs, we should all be very humble about the choices we make. We're in a business where we're always wrong, right? It's a lot like scientific research, where your great results come at the expense of many results that have failed. Same thing here. We make a lot of investments that don't work. So due diligence is not foolproof also means that you're not always wrong. Just because I'm not making the investment doesn't mean you have a bad idea, all right? There's all sorts of reasons why I might not do it. I like these examples because they're outside of our field, and they come from, and I invite you to see it, the reference is very, very light at the bottom there, but it's the Bessemer Fund. Bessemer is a huge billion-dollar fund that doesn't invest in healthcare, unfortunately, out in Silicon Valley. And they have on their website the anti-portfolio, so all the bad decisions that led them to not making investments. And why is that? So they saw Zoom before the pandemic. WebEx existed. and other programs existed. And, this whole idea was, we still spoke on the phone and we were perfectly happy with the little machines in the middle of the table where everybody spoke into it. That was fine. We didn't need to see each other all the time. So they're like, it's a crowded space. We don't really understand it. We're not going to do it. It took them 5 minutes to make the decision. It was sheer bad luck because they couldn't have anticipated the pandemic, right? And how that changed the business plan completely for Zoom. So they missed out on a $9 billion market cap at IPO. Then eBay. Someone explained to them the business of eBay in the very first round in seed financing of eBay. And they're like, stamps and comics books, and you're gonna sell this online, and why not have a garage sale, and how's this gonna work, and how is even payment going to work, right? Because now you put your credit card everywhere, but in those days it was a little bit less clear. So they're like, yeah, no, never mind, moving on. And eBay had an IPO of 1.9 billion. So obviously someone thought it was a good idea. So sometimes not understanding the premise can hurt us as well. And it's your job to make us understand it. But, if we don't want to, or if we can't, or whatever, we might not get it. Kayak, if anybody remembers Kayak, it was a question of faulty due diligence. So they were interested in Kayak. It was a travel website, essentially. And what they did is they did due diligence on Kayak, and Kayak's business plan at that point had it so that airlines would pay a fee to be listed, to have their flights listed on the website. And the people who were tasked with doing due diligence at Bessemer called up some airlines in the industry and said, so would you pay a fee to be part of it? And the airline said, no, why would we do that? And so they said, oh, well, they did due diligence. The business model wasn't going to work. And they were correct. Airlines never paid to be on Kayak, but hotels did. But nobody thought to ask the hotels. And so therefore the due diligence made them make what ended up being the wrong decisions. And Kayak was sold to Priceline, another one that dates me, for 1.8 billion. Airbnb, they did all the due diligence, everything worked, they got the meetings, everything was good, but they negotiated when they tried to lead the investment and went to pre-money valuation. So how much do I think you're worth? And how much is it going to cost me to invest in your company? Well, they thought 40 million, there's no way, this is ridiculous, it's not worth that much. And they did an IPO at $47 billion. So obviously wrong judgment call there. And these are mistakes we make all the time. So don't lose faith if people, if it's been 15 years and you haven't raised a cent, maybe you should start losing faith. But collect the no's before you start to lose faith, okay? We make mistakes as well. So congratulations, you've gone through all of that, due diligence, you've made a billion pitch, and now you're in negotiations. Awesome. What's gonna happen? We're gonna have to set your valuation. We're gonna have to set the value at which we're going to make the investment. What price per share am I going to pay for those shares of yours? Because what I do when I invest is I buy shares from your company. The most, if we were across the street at Des Hotels, they'd say, you develop a model and you use an NPV, net present value calculation, and that's how you select your valuation. NPV measurements are based on sales forecasts. You have a target and a hit. So how many assumptions are you going to have to make in order to build that NPV model? It's going to be so many assumptions that it's fictitious. So we don't use NPV calculations at all. Does that mean you don't exist? Obviously not. You're sitting across the table from me. So what are we going to do? From the VC point of view, I'm going to look at comparable companies. Right now, startup companies that are in oncology, how much are they worth? The last deal I did was at what price? The last deal my buddy did in another fund, what price was that? And I'll start comparing. I'll compare not necessarily, I'm not going to be looking for the exact replica of your company, but in general, startup companies, what price are they at? And it's the same for you. When you try to figure out what your valuation is, do your homework, go talk to people and see what the values are. I'm also going to look at how large are historical exits. I'm going to be a little bit more flexible on valuation if I think it's a $2 billion exit than if I think it's a $100 million exit, right? Because then the price I'm paying at the beginning in order to get my target return on a $2 billion sale is going to be more flexible than if it's a $100 million sale, if that was clear. And how much capital is going to require to get to that sale? That's also going to be an important factor. You're not going to care that much about that, or you could care about it, but what you care about most is how much do you need that money? It's quite that simple. I have money, you don't have money. You want to develop something. Do you want the money? Maybe not. Maybe there's a price that's too low for you. Okay, but you're gonna have to find another source of capital. So you have to think about that. It's like, you sell your house because you've gotten a promotion and you have to move to New York within a month and you need a lot of capital to buy an apartment in New York. Well, you're going to be a bit more flexible on the price of your house in Montreal than if you're deciding to maybe move in 2 years because you'd like a second bathroom, right? The two situations are completely different, and it's exactly the same when you're fundraising. If you've got payroll to meet in 3 months, and you're in the middle of really interesting results and interesting research, you're probably going to want the money a little bit more. If you're only talking to one VC and everybody else has said no, you might be a little bit more desperate than if money's flowing in through the doors and you don't know what to do with all these calls. So think about it. Then you're going to negotiate. The first thing that you'll receive is a letter of intent, also known as a term sheet. The lead investor is going to put a letter together that basically gets the ball rolling and tells you what kind of terms they're expecting for their investment. You can negotiate the term sheet. They're not necessarily going to get everything they want. It's also going to be in there are the conditions that they have to meet or you have to meet before the closing actually happens. So sometimes that's you're going to need this bit of result, or sometimes it might be that I need to go to my own investment committees and get my own approval. So you'll get all of those and you'll know exactly where you're headed. The key terms, obviously, how much you need to raise, how much I'm going to put in as the lead investor, what valuation we're going to be doing this deal at, what decision rights do I want, how is the board going, what the board composition is going to be, and like I said, the conditions to closing. Once we've all agreed on those terms, then we get to negotiating what's called the subscription agreement and the shareholders agreement. And those take a lot of time, and they take a lot of time. And you are going to take a lot of time and energy, and you're going to pay a lawyer a lot of money to get to the end of that process. The subscription agreement basically tells you all the terms related to this financing round. The shareholders agreement regulates how shareholders interact with one another throughout fundraising, like throughout the different rounds of fundraising, and what the rights are of each shareholder, common shareholders versus preferred shareholders. And the fun thing about these agreements is that you're going to spend a lot of time discussing arcane bits of legalese that you've never thought you'd ever become interested in, but you're going to spend hours negotiating passionately over many Zoom calls, and then you're going to take the agreements and you're going to put them at the bottom of a drawer, and you're not going to think about them until there's a problem, and there probably isn't going to be one. Not a legal one anyway. There's going to be many technological problems. But unfortunately, you have to get through it, and you have to have a very good lawyer that understands what your goals are versus what the lawyer's goals are. And we're not going to be cynical and say their goal is to earn a lot of money out of your transaction. Their goal is actually to protect you from a legal point of view. And sometimes there's a difference between the kind of risk you want to take as a business and the actual legal risk you might be taking. So you need a lawyer that's able to see the difference between what's important from a business point of view and what's important from a legal point of view. And then you'll be closing. So congratulations, you've closed an investment. This is awesome. What's going to happen next? Well, you're going to interact not so much with your investors anymore, right? Like you've negotiated the terms that in that period, you're going to speak to them every day. And then eventually the board of directors is going to meet every quarter. I encourage you to keep a very close relationship with your board of directors. Your major investors will have a seat on it. Minor investors might have observer status or not. Observer status, it means different things for different companies, but it's basically you're there, you listen to the conversation, but you don't really participate in the discussions. And when they're very important matters with high confidentiality, you're politely asked to leave the room. And you'll have perhaps some independent or external directors because you need a specific expertise around the table, and those are going to be named by your investors. The advantages of having a board of directors that has a lot of your shareholders, your investors on it, is that the groups who will provide you the next round of funding, or at least part of the next round of funding, are around the table. They've gotten to know you, they trust you, And they're going to be more ready to open up their purse strings. So they're not going to be the ones you're going to have to convince the second time around. And it also means that if you need capital because there was a problem, you need like a quick injection of cash, they're going to be able to say, okay, we're going to do this small financing just amongst us, not with the outside world, so that it goes faster. They can help you in the fundraising. I spoke about their network. And again, the network. They can help you in the fundraising also in terms of what to accept as terms for the next round. The issues with having a board that has many investors on it is that we have either too little or much too specific expertise, right? I'm not a drug development expert, I'll tell you right away. That means that I might ask questions when you talk to me about the program that are not necessarily germane to the role of a board of directors. And we might get lost because I need some handholding in making decisions. It also means that you might not have as broad an access to different expertises that you would need if your board was more independent or external directors. The biggest problem, though, is that all investors might remember that time in life of a VC and where you are depends on what you want to do, and returns need to be generated to raise another fund. Well, all your investors around the table are not going to be at the same stage of their cycle. So the biggest problem this generates is if you have one fund who's like at year 11 and another big fund that's at year 2, and you need to raise another round, or you have an exit offer on the table, that's maybe not the price you wanted, right? Like you were aiming for the $1 billion sale and maybe you're at 800 million. Well, guess what the investor who's at year 8 is going to say? They're going to say, take it, sell now, please. The investor who's at year 2 is going to say, if we get to this next stage, we can go get that extra 200 million. I don't want to. And you are your management in the middle of that, and you have to arbitrate between all these different opinions. That can cause issues. It can also cause issues if you're trying to do the next fundraising and you're going to need your existing existing investors, a little bit like the question you asked, but from the company perspective, you're going to need your existing investors to pitch into the next round, or else it's not very convincing for new investors to come in. But if one of them's at the end, doesn't have bandwidth anymore, doesn't have dry powder anymore, no money left in their fund, they might try to block the fundraising because they're going to be hurt by that next fundraising. So you say, I need 10 million, they might say 10, maybe you could do with 3. You do the same thing with 3. And so that'll create tension amongst your board, and it's going to be your job to understand those problems, understand everybody's issues, and try to figure it out properly. You also have the problem between yourselves and the shareholders. We signed all these nice documents. We agree on everything. We should be all looking in the same direction, right? Are there irreconcilable differences because the investor needs an exit? Because this success is going to help them raise their next fund. You, as the CEO or as part of the management team, you're going to want to build a company, right? Like you're in this not for the quick flip. You wouldn't mind the quick flip, but you're there because you want to build something of value. You believe in your technology. You want people to keep investing. You have your team, you're paying for them. You like these people. You want to keep these people on board. And eventually you want to help patients, right? You want to see your technology help a patient one day. Are these very different points of view? Like, are they irreconcilable or are they pretty similar? What do you think?
It really varies. If the fund really wants to raise the next round and they probably don't really care about the technology or the future promise of the technology, they probably prefer to get exit done.
Mm-hmm. In a specific situation where there's an exit in front of you. Yeah. Probably.
So it really depends on the situation.
It depends on the situation, but are the two views completely opposite? In other words, will they lead you to build a business differently if you want to get to an exit or you want to grow your company? Does that mean fundamentally you're going to be doing different things, or seeing is your strategy going to differ if you have one or the other of these two goals?
Not necessarily.
Sorry?
Not necessarily.
Not necessarily. Why do you think?
Because again, if you are building something that is actually creating value for patients or somebody, then you're closer to that exit.
Yes, exactly. They're not as irreconcilable as they might appear. There are different ways of looking at the same thing, and that same thing is you want a company that's a good company. A good company is going to be able to be sold. A good company is going to last, right? So in the midterm, you have the same goals. The difference in goals are going to come when you get to the discussion of exit. And I've seen that in a company that we sold in 2023, a company in obesity, we sold it for above $1 billion, right? And I saw the cap table, I saw how much the management team made, and yet the management team still thought, we don't want to sell. Right? Like if we go through phase 2, we really believe in this and we're really enjoying working together and this is a great team and we just want to push this further and it's not worth $1 billion. It's worth $10 billion if you wait just a little bit more. And while the investors said, oh, that's really good. We applaud you for those thoughts, but we're going to sell anyway. Because come on, guys. And they looked at the cap table and saw how much they were making and they said, okay, maybe we'll go get another dream now. But the bottom line was they had built a relevant plan. They had gotten good results and they had the resources to achieve those R&D objectives, right? So that is what a good company looks like, whatever you want to do with it at the next stage. And if the exit unfortunately means that your involvement is going to end, that's difficult, right? The technology is your baby. You've been growing it in an academic lab and then grown it outside and you've had all these conversations with these stupid VC groups who never say no and always tell you next week and it's always 6 months and then it's 18 and you argued about indemnification clauses in the contracts and everything else and you've had the board meetings and everything and what, you want me to walk away from it now? Are you kidding me? Finally, we're close to success. Well, truth is that especially if the exit is a sale to a pharma company, you probably are a step closer to patients than you were before you sold. Because the pharma, despite what I said about strategic change and everything, are probably a little bit closer to being able to push your program through the clinic than you might be as a startup. The other thing is you're going to get a nice financial upside. So, that's not too shabby either, maybe a new house or more. And you're going to have the opportunity to start a new adventure. And this time you're going to start a new adventure with new technology and more knowledge and more experience. And it's going to be hopefully less painful than the first time around. So I think you have to look at it as a positive rather than a negative that you have to abandon the child that you raised. That's probably not the best comparison. Don't tell my children. But basically what I'm trying to say is that your board of directors, your investors, they don't, even if they come at it from a different point of view, they're not thinking about your company that much differently than what you are. And an exit is a good thing for everybody.
Okay.
Yeah.
That's very quick. So would an exit like this type usually add a non-compete agreement to the founder? Probably.
It's a limited non-compete, like maybe it's 2 years. But yes, they will not want, the acquirer will not want you to compete with them by starting up another company with exactly the same technology or similar technologies. So it's a nice time to take a holiday, which you probably need because of all those conversations you've had with VCs, all these discussions about indemnification clauses and late nights of work. So what does it? I keep talking about exits. What do they look like? Well, they can be a sale of your company or an IPO. So an M&A transaction, a merger or an acquisition transaction, the acquirer will buy 100% of your shares, of all the shares of the company, and it becomes theirs, and it becomes their problem. A collaboration, when I was talking about the pharma collaboration revenue, that's not an exit because you still exist and you're still running part of the show. It's really the acquisition of the shares that makes it an exit transaction. An IPO, so once you first list yourself on you obtain a first public listing on a public market, it's also not quite an exit because guess what? You're selling new shares to the public markets, but your own shares become public shares. They're not acquired. So you still own shares, they're just now, they're public, you're probably going to be banned from selling them for a certain period of time. After that, you can start selling them, but you're only going to want to sell them if the price is right. So if you did an IPO at a very high value and then it goes down, which is completely normal, well, you're gonna want to wait a little bit longer before you sell them. So it's not, technically speaking, an immediate exit, but it allows you to raise capital of a completely different nature than you can do in private markets with VC. Public money is a lot more generous than VC money. Yeah, so that's, but you'll still probably be involved because the company continues to exist. So when we're talking about building a lasting company, a sale is obviously not building a lasting company, but an IPO is, because the company still exists. What are our success expectations? This is something that I don't want anybody to come back to me in 6 months and tell me it's not actually a third. It's more like some other percentages. But the rule of thumb is that we expect a third of our portfolio to fail. We expect a third of our portfolio to generate a neutral return. So gave $1, got $1 back, maybe $1.10, maybe 90 cents back. And we expect 1/3 of our fund to be home runs. So I have 1/3 of a fund to carry 2/3 of a fund, right? Every time I make an investment, I have to hope that investment's a home run, right? I cannot hope that I'm going to get maybe 1.5 multiple of return, because that's not going to be enough to carry the fund. So that's how we build a portfolio, is hoping that every single investment, we can convince ourselves that there's a possibility of a high return. But that's a lot of mistakes. If you see them as mistakes, obviously you make decisions based on the information you have. You didn't know that it was going to fail in phase 2 in 5 years when you made the investment, but it's a really tough business. It's almost as tough as, running a biotech company. And the main problem in creating returns in life sciences is that, and that, technological success is actually elusive. Like, all the targets we discover do not make good drugs, right? All the good chemistry we put in, or the good biology, if you're developing a biologic, is not necessarily going to lead to the result you expect or want in a human being. And not necessarily always to the right level of statistical comfort either. So it's really a tough business. You're not selling apps, you're doing something that's incredibly difficult. So obviously lots of risk. The good thing about it, though, is that it's a highly regimented, I'd say, process, right? Like, we know exactly what we need to do to develop a drug. All the steps are predetermined. You're probably not the first to have developed a drug in your own market. So you have a lot of past examples to look at. There's a lot of data available out there. As a fund, unfortunately, our position diminishes with time. We may start and own 10% of a company, but then as more investment piles on, as more series of funding pile on, our position is going to get smaller and smaller and smaller, unless we were constantly able to put in if I own 10%, that should mean that I invest 10% of the next round. But just think about it, we're a $45 million fund. Let's say I start by owning 20% and the next round is $20 million. Well, then I'm not going to invest 20% of $20 million. I just can't. So that means that my position is going to get crammed and crammed and crammed. And then also because if I can't reinvest, I might lose some privileges. So let's get to that. How does an acquisition work? Well, when we start up a company, the founders in these institutions will generally receive what are called common shares. Employees and other contributors to the future. So the common shares should be seen as the reward for the work you have done in the past, okay? The ESOP, the stock option, is there to reward people that we want to stay on board, right? If you are a founder and then you never touch the technology again because it's completely in the hands of someone else, nobody's calling you ever for your opinion, you're not going to get ESOP, right? You're not going to get stock options because you're not required for the future of the business. You'll have gotten founder share, but not stock options. But unfortunately for you guys, venture capitalists make money because they receive preferred shares. Because we're very special. And what is this special preferential treatment? we'll get anti-dilution provision. So if the next round is done at a price lower than the round I invested in, I'm going to get extra shares to make the difference. It means that we're going to have specific control over certain issues that you're going to have to ask permission nicely to do as management. We're going to get board representation, so we get to have our say. We have first payment when an acquisition occurs. We get the first piece of the cake comes to us. And we sometimes even get two pieces of the cake when an exit occurs. Those are all provisions that we add on in order to make the investment worthwhile for us and in order to counter this. So let's look at an example really quickly. Let's say at founding, common shares were 20% pref A. So the first round of financing, the preferred shares class A are going to get 25%, my pref Bs. So the second round of financing have 40% of the company, and the ESOP is generally set at 15%. And the ESOP is separated amongst all employees. So once we get to an exit, well, the first thing that's going to happen is that the ESOP is going to get exercised. So an option to buy a share is basically telling you, you're going to be able to buy a share at this specific price at some point in the future. So if there's an exit, now's a good time. Don't ever exercise ESOP in a private company until you reach exit. I am not kidding. Do not throw your money away because the shares, you're not going to be able to sell them. Okay, so do not spend money on buying those shares until you reach an exit. So the ESOP is going to get exercised, and they're exercised in common shares. So the 15% of ESOP becomes part of the common shares. That raises up to 35%. The $100 million exit, I'm not being very positive with this exit. This is a mid-sized exit. I'm satisfied. It's not partying any. So the pref Bs are going to go first because we said first payment occurs. And it's always the last people in are the people who benefit the most from these preferential treatments. So pref Bs are going to get 40% of 100 million, so they're going to get 40 million. The pref Bs, there's 60 million left, are going to get 25% of 60 million. They're going to get 15 million. And then comes the common shares. But I did talk about double dipping and getting two pieces of the cake. So now we're going to convert all of the pref As and pref B into common shares. Thank you very much. So we're going to come back a second time. With the pref Bs are going to get their 40% of the 45 million that's left. The pref As are going to get 25% of the 45 million that's left, and the commons are going to get the 35%. So at the end, my $100 million exit is going to be roughly 16 million for the common shares. That includes the ESOP, so that's all of you, the management team. The pref As are going to have made about 26 million, and the pref Bs, they're the ones who are getting out of this really happy by getting out 58 million. Okay, so that's how the exit actually works. If you transfer to different things that can happen is if I was an investor in pref A's, but I don't have money to invest in pref B's, my pref B friends, this is the frenemies, are going to say, well, if you can't invest anymore, we're going to transfer your pref A's into commons. We're very sorry. So now you're like with the common shares, you've lost all the privileges of the pref A's, and they're also going to say, yeah, and we're not going to convert 1-to-1. Like you're not going to get one common share for each pref A share. We're going to convert like maybe 2-to-1. We're really sorry. And then what am I going to do? I'm on the board and I'm looking at this going, what? Like, this is insane. What are you doing to me? But it comes back to, you want to sell your house because you want to move to New York next week. I'm going to look at it and say, I don't have a choice but to accept these horrible terms that I really hate because the company will need money. And at the end of the day, if I block this sale, if I can block it and I decide to block it, I'm essentially tanking the company. So it's better to have a smaller part of a larger pie than having a huge part of no pie at all, right? So I am going to accept those terms. So we had, I'll tell you a very sad story. I'm going to tell you the story in terms of how we measure success. So the success estime, which is the one on the right, those are the successes that you're like, it's a very nice story. So I'm going to tell you a very nice story right now. So this happened to us. We invested in 2001 in a company in Britain who was at seed stage that had an oncolytic virus. Okay. We thought we were being very clever, and we were. We invested in it. I sat on the board. For almost 10 years of that company. And we raised, I think, until Series E. And so we raised, and we participated in every series until Series D. And then Series D came, they'd moved to the US, I'd supported their move to the US, helped them through that, at some point, we were running out of cash, there was no money. It was 2008, there was no money. 2008 was a huge economic crash, for those of you who remember. There was no money to be raised, and they were like 3 months away from no runway anymore, no money. And we decided we'll try to do an IPO. Maybe we can do a small IPO and just get that money through. And I was the last VC sitting on the board, because all the other VCs have to usually VCs step out when you become public. And I helped them through that. The IPO didn't work out, and we continued, shoestrings, managed a tiny bridge financing with the investors around the table, and eventually got to Series E. And the investors came in and said, now we're raising 45 million because we're going into phase 3, and this is an important thing in oncolytic viruses, cost a fortune to manufacture, and they were manufacturing themselves. And we looked at that and said, we can't do it anymore. It's so late in our fund and we don't have the dry powder. And I, as a board member, also said, well, I just don't think it's going to work anymore. Like, it's been so long, right? By that time, it's 2009. It's been so long, and I really think that the fund, looking at all our other portfolio assets, should keep whatever dry powder it has, very minimal at that point, should keep it for the other assets. Okay, that was my position. We didn't invest. The other investors around the table said, it's very nice, but we're gonna have to convert you to comments, and we're going to have to convert you on a 5-to-1 basis. And, good luck to you, and thank you so much for carrying this company all the way through here. The company was sold for $1 billion. I was on mat leave. I was reading, breastfeeding and reading my email. And then I saw this press release, and I'm like, we sold BioVex to Amgen for $1 billion. And 2011, $1 billion sale was a huge deal. Like, now it's kind of like, oh, I sold for $1 billion. Oh yeah, really? Well, what happened? How come you lost out? But in those days, it was a really big thing. And I thought, my God, like, they sold for $1 billion to Amgen. I texted the CEO, and I'm like, am I dreaming? Is it because I'm not sleeping? Like, what's going on? No, it was confirmed. We followed that story for over 10 years. We invested about $9 million that, unfortunately, we invested in pounds, which killed us on exchange rates. And then we invested in US dollars, which killed us up twice. We have a neutral return on $1 billion sale. Okay, just because I made that decision to say to my partners, let's not reinvest, which was not necessarily the wrong decisions. I mean, it is in hindsight, but at the time that I made it was not necessarily the wrong decision. But that is a story that just got me like 3 minutes of your attention that unfortunately got us $0.
Yeah, so I have a question regarding Meta. So how did it happen the Zuckerberg didn't get diluted throughout all the investment rounds? Is it possible to do it right now? Or not?
It is possible not to get diluted at all. You just have to have very deep pockets and be able to follow or have special rights that prevent dilution.
Okay.
There's a question from Philippe Gros here. Can you please explain what an anti-dilution clause is?
Yes, an anti-dilution clause is if I invest at $5 per share, then I get a certain number of shares from that investment. And if the next round is raised at $1 a share, then my shares just lost $4 in value, right? So then small number of shares I had are worth suddenly a lot less than they were when they were $5 a share. So in an anti-dilution clause, the company is going to have to give me shares in order to cover the gap, to bring me back to the original, to the equivalent of $5 a share. Does that work, Philippe?
I think so.
Okay. So yeah, so the succès d'estime are really nice stories. Unfortunately, they don't necessarily help you raise a fund because can founders get anti-dilution? Well, yeah, sometimes common shares get anti-dilution as well, but it's rare. Because usually it's considered part of the preferred package. And that's the problem with founders, is that it's good if a founder can stay involved in the company and get ESOP, that's a very good position to be in. Because if you don't, then you're inevitably going to get diluted as time passes. And you're going to get more and more preferred shared rounds piled up on top of you, so that your return in an exit is going to be very small. But if you're part of the team, if you're part of moving forward, then your options might be a good return, generate a good return. So there's the succès d'estime, there's the impact success. This is more and more important for a lot of investors, is to show that you have impact beyond the financial return. Unfortunately, for whatever reason, impact investing started in clean tech, and nobody thought that healthcare, was a good impact, was defined as an impact investment, but it's becoming more and more part of the discourse. And that's just basically looking at environmental, social, and governance measures that are defined by the UN, and seeing if you have a true impact on things like knowledge of your country, or health of the people in your country, or governance, if you're doing good governance and things like that. So when you measure your impact success, you don't necessarily focus on the end game. You don't focus on, am I saving patients' lives? Because in all likelihood, your own participation in the saving of the lives is diluted by the efforts of other people in between. So it's really just how your impact works, how your intention is to make a difference on the way towards saving those patients' lives. And you're going to effect a change with your solution in the way that people do things. So impact success is important for certain investors. That's the bottom line, and they will ask you to measure it, and they will probably tell you how. And the financial success is the holy grail. Okay, that's like this sale of the obesity company I was telling you about in 2023, the one for about $1 billion. Well, that generated a very nice internal rate of return, which is a magical calculation that takes into account the money that you invested. It takes account the amount of time it takes to get to exit, and obviously the price at exit. The problem with life sciences, well, actually, to be fair, the problem with many technological spaces, because the time to exit is, we always think, oh my God, life sciences take so long. It doesn't really take more time than tech, than IT or clean tech. Everybody takes about 6 to 7 years to exit. Life sciences probably requires more cash, okay? The multiple, I find, is a much nicer measure of our financial success, because it's basically exactly what it says. It's the amount of money you got at the exit over the amount of money you put in. So the multiples are not dependent on time. Time has a huge impact on your internal rate of return.
You're evaluating those people you might want to invest in. So what's your target for return on investment, percentage-wise? Do you have a target, or do you evaluate that?
I'll look at it more from a point of view of multiple. Like, I have to make at least 2.5 times the amount of money. So that's how we measure we have to measure our success in order to sell ourselves to our LPs. And as interesting as that BioVex story is, it hasn't helped us raise a fund, or it hasn't factored in to raising a fund. So that's where we end. I will tell you all, be very patient. It is a painful endeavor. It's one that I admire. Anybody who goes down this path, I am in endless admiration for, because it takes a lot of abnegation. It takes a lot of courage, I find, to go down this path. Don't be greedy in terms of your valuation at startup. It's not worth keeping a huge percentage of your company if you're not raising the amount of money and have the right players around the table that will help you make this company grow. Be flexible as well. Maybe people are offering you changes to your plan. They will offer you changes to your plan. Maybe they're not wrong with the changes that they propose. Maybe they are actually helpful. This obesity company, when they first came to us, it was a CB1 agonist, and CB1 had a huge success a few years, well, almost 10 years ago, but was pulled from the market because it had suicidal ideation side effects that were only seen once it was on the market. So when this company came to us and said, hello, we have a CB1 agonist, we went, are you kidding me? Like, what? No, like, nobody's gonna want to do this. They said, oh no, but CB1 is a good target, but it's all over the body, it's in the periphery, but also in the CNS. And the suicidal ideation came because the drug that Sanofi had developed penetrated the CNS. But this company thought, if we don't penetrate the CNS, then we're all good. We're going to affect CB1, agonize CB1 peripherally. That still has the weight loss issue without having the psychiatric issues. And they had a plan, and that plan was going to cost about $10 million, and we were leading, and we weren't able to raise the $10 million. We couldn't convince enough crazy people like us that CB1 was a great target in obesity. So then we went and proposed to the management team of one person, the CEO. We said, why don't you first let's fund you just to do that experiment that shows that your compound doesn't cross the blood-brain barrier. Because if it does cross, you're dead in the water. But if you don't cross, then you'll be able to answer a lot of investors' questions and maybe get them on board. And that's what we did. And just having that plan allowed us to get $6.8 million together from different VCs in order to fund him. And then raised two more rounds and then sold for $1 billion. So the ideas that we bring to the table are not necessarily stupid. Just remember that. And read between the lines too. Right? If someone tells you, oh, like I have a new fund coming, I'm gonna close in 2 weeks, maybe not. If it's the 6th conversation you've had and you've answered 20 pages of due diligence and there's still no term sheet, maybe it's time to step away. It doesn't mean you tell them, screw you, I'm gonna go get money from someone else. It just means maybe you don't spend as much time talking to them and put all your hopes in that investor. So learn to read between the lines. Again, FOMO. Saying no, worst thing we want to do. If we say no, it's a real no because we don't want to get there. And that's it.
Wonderful. We do have time for questions. If there are any questions online, you can put them in the Q&A function. Are there any questions in the room to kick us off? Or if not, well, go ahead.
Are you only interested in startups that are already formed, or would you create a startup with a founder?
Yeah, I should have started with what I do in my daily life. So AmorChem does both. AmorChem, we invest most of our portfolio. So we aim for a 16 asset portfolio. 12 of those are university projects that we first validate with an investment of about 1.2 million over a period of about 18 months. And then if the validation is positive, we spin out a company. And we do the $1.8 million seed investment and create the company and find management and everything. We have 4 assets that are companies that already have management that have already been created because those are a little bit later stage and they decrease our risk a tiny bit.
Are those 4 from the university still? Or
They don't have to be from university.
But it could be.
The 12 have to be. The 4, we're agnostic. They could be like the Inversigo, the obesity drug came from the NIH. So it came from a university, but it was a Montreal-based company that got an NIH compound.
I have a question about how much local or Canadian VCs like speak to one another. So example, you come to McGill, you come to D2R next week and you see a project, you see a pitch. Do you keep that for yourself and do your own analysis, or when does it come the time that you might speak to another group and say, hey, like I saw this project, we're interested. Are you also interested? How does it work?
Well, it works that we start just on our own and make our own minds up about something, and then we will open doors to other people. But it's not our job to raise money for the group unless we're working with university projects, and then it is our job to find other, because we realize there's no company or anything. But the moment that there's management, we will introduce to people and we will put in a good word. But the moment we become interested, and particularly if we become the lead investor, then it's our job to make sure that the round is closed and that everybody else knows about it.
And so can you create sort of like emphasizing on that FOMO, like speaking from like the D2R perspective, by showcasing a project at D2R to a whole bunch of groups and trying to create that like buzz?
Yep.
So that's
how you do it.
the
You
approach.
talk to as many people as possible and hope that you have a buzz. So the one thing is, in life sciences, we rarely compete for pipeline, right? So in IT, for instance, people are fighting to get to finance certain companies, and that's because they don't need a lot of money. So if you can write a $200,000 check, well, that's the financing round, all of it on its own. In life sciences, we always syndicate investments. There's usually more than likely more than one investor around the table. And so there's no competition, right? Because we all want to do it,
Right.
And we're all needed. Or if we're not needed now, we'll be needed for the next round anyway. But you have to create this excitement so that if I see someone from another fund and I'm like, oh, did you speak to about this project? And they get excited, and I'm like, oh, okay, well, we're two people that are excited, we can't both be wrong.
So if we're talking about like, innovation at the university and entrepreneurship from our labs, coming out of our labs, the best approach if there's that interest is to really like speak to as many VCs as possible.
Yes.
Okay, so hopefully we're going to continue to bring those types of opportunities at D2R.
Yes, I hope so.
Great. Any other questions?
Fantastic presentation, like from start to finish of the VC's life cycle. I really loved it. So I was working for Healthy Brain, Healthy Lives, right? I'm working for D2R with a fantastic team. I have a couple of questions. So basically, when I work with researchers, when I talk about, planning commercialization, for example, they often have this mindset that if they take in VC money, they lose their child, the research.
Yeah.
So how would you tackle it? Because some of the projects are really fantastic, they have potential, but then the professors themselves won't want to give this project or take it to the next stage. So what would be your message for that?
Well, there are two things. The first thing is we've learned that you don't want to work with someone who doesn't want to work with you. So at the very basis, if we go talk to a PI and they're really not interested in giving up some of the control over the project that they have, it's probably not a good fit, right? So in the first fund, we tried to push people a little bit more, and we realized that the only way that we can hope to reach success is if everybody's on board and everybody understands. The other thing we do a lot is just show off our own expertise, right? Like it's not just about the money we bring, it's about bringing your project, your fundamental research project into the translational world, right? Into the drug development. So what do the people in my team offer and how can they help? And then there's the money. That's very important. It's like, okay, I respect the desire to keep control, but that means you're going to have to find funding elsewhere.
Yeah. So
it's not a magic conversation. And I think that more and more people are letting go of that point of view. Like when we started AmorChem in 2000, the first AmorChem in 2011, it was very hard to get through to that, right? Like what was even the value of commercialization? Why do you want to do this? But I find that more and more people are inclined to wanting to do it and understand the value. Some people won't, because if you start commercialization very early on, your lab is going to have to be slightly reorganized, right? Because your results have to come in fast and furious, and you have to put in people who can deliver those results very fast. So that means sometimes when we invest in a lab, the PIs will have to put, technicians or RAs into our project, and maybe not so much students anymore, because we love to have students on board, but they're not going to be the most efficient, right? And we have to meet timelines and budgets. So it requires a new thinking about what research is. The other thing is you have to be clear that the steps of drug development are necessary if you want to help a patient. You can't get away from it. You can't get away from the cost. But you have to understand that the research of drug development, not super interesting from an academic point of view, right? If you do medicinal chemistry, let's face it, you're doing the same assay all the time on many, many, many molecules until you get a really good molecule. But you have to understand that. You have to understand that that has its own value, and it's required if you want the thing to go further. So I think it's just having a really honest conversation and hoping that those points come across.
I have another question, but I'll give the space to others if they have any questions.
Go ahead.
Okay. So the other question I have is like basically based on we also had I was participating in other discussions as well, and so basically like a lot of researchers, we are more like towards attention to details. Like when we take a compound, we often try to characterize it as much as possible, learn from it, blah, blah. But to a VC, it may or may not be necessary, because for a VC, it's more like they want to test the idea and try to make it fail as early as possible before entering the market or before doing stuff. And so at AmorChem, is there a validation step? For example, do you want the researchers to do like toxicology study or something that makes you think that, okay, this is the good drug candidate, and I can take it to the next stage?
Well, I think whether it's AmorChem or anybody else who invests in startup companies or who invests in university research will have to realize that the projects are super early stage, right? You can't ask for all this characterization. It would be nice if at least it was thought about, right? Like what kind of toxicity profile do you want? Do you want this drug to be administered orally? Do you want it to be injected? Does that make sense in the market that you're in, that it's injected versus oral? You wanna see are there any characteristics that might block, right? Like if you're developing something for the liver and it's highly, well, in any drug, if it's highly hepatotoxic, then it's a no-go. But like you have to look at all the characteristics of toxicology and all the other characteristics and see what does your ideal molecule look like. You don't have to have achieved those goals because it's understood that that's not necessarily the expertise that's developed within the university. It also probably is that the compound that you develop that you think is a great compound is actually probably not that great, and we're going to have to optimize it further. So a lot of characterization at the beginning is going to be pretty useless because that's not ultimately the molecule that's going to be sold. So I'd say what VCs who work with universities really want is not like a nicely baked cake with all the icing and trimmings. It's a really novel recipe. Right? We want innovation. We want what we're aiming for in universities are these brilliant ideas that are groundbreaking, that are not like I wouldn't right now go into university looking for an obesity project because by the time that reaches any interesting stage, pharma will have shifted to the next interesting indication. But all these great ideas that come up, that are unproven, right? That are really going to change the paradigm of treatment of patients if they do reach their potential. That's what we're looking for, not a full answer.
Thank you.
Any other questions?
Definitely. So you mentioned that your fund only invests in Quebec.
Yeah.
So what are the considerations going to that decision?
Well, the main consideration is that the government of Quebec is a huge LP, and so is the Solidarity Fund, the FSTQ, and they have a Quebec perspective. So at inception, we were built. Basically, the idea of AmorChem was that they wanted a private fund that would focus on the Quebec ecosystem in order to make sure that there was more commercialization coming out of Quebec universities. We've done a couple of investments in Ontario, but yeah, our funders were really the basis of that decision. Also, I would say that startups are done, and when you look at different VC groups that can fund you, it's important to focus on the local ones, even if you believe that you could get more money from a fund in Boston, because my God, there's so much money in Boston. Starting up companies, it's a contact sport, right? It has to be done with a lot of interactions. You have to really understand the ecosystem. You really have to understand what's going on. And actually, and Philippe, if you're still online, you might enjoy hearing this story, but when we launched AmorChem 1, or when we decided to go for that money, at first we laughed because, this was 2009, right after a huge economic crisis. Who the hell wants to invest in biotech startups? This is never going to work. And then we looked at our portfolio and we looked at the successes that we'd had in startup. And the funds I worked with previously, the originators of AmorChem, we had invested all over the world at all stages. And when we looked at the case studies and looked at every investment we'd made with the 3 funds we'd had under management since 97, we saw that the best successes we'd had were the ones where it was basically McGill researchers that worked with us. We started up a company and those were successes, and at least one of them was Philippe Gro's company. So when we really looked at the details, we thought, okay, that's the first rule. If you want to start up something, make sure you're in the same place physically, because it's very hard to manage research and to manage a research team from a distance.
To attract VCs more here and like more funding with this model, maybe I
Yes.
with the government.
Yeah.
I don't know. It just always talk how to retain, how to keep them here, companies and startups.
There's a big conversation right now about what they call anchor companies. I'm not sure why we call them anchor companies, because that feels like you're like you're leading them, but I'm not going to argue. They're called anchor companies, I guess, because they anchor the rest of the ecosystem. It's the foundational companies. There's a lot of discussion about wanting to build companies that last and that become, huge companies here rather than get sold early on, but you need a lot of capital to do that. I would argue, and I can tell you why, but maybe not to the whole group, but I would argue that you don't really need good anchor companies in order to have a good ecosystem. But those who advocate for that really would like us to not exit companies and just grow them bigger.
I guess maybe we could save your question
Yeah,
for
yeah,
the
yeah.
discussion afterwards. I want to give you sincere thanks for really an excellent presentation discussion. Thank you for the questions from the audience, and thanks for attending.
Thank
Thanks
you.
so much.